In this video, I'm going to make a lot of these signs, and that's because we will be talking about CFDs. When it comes to CFDs, a lot of terms that are used are not real and don't mean what they usually mean. That's why this sign is so important. One thing that is always real and always means the same is the risk of losing money, which, by the way, CFDs involve a lot of. So if this intro was as confusing to you as CFDs are, please keep watching, and I hope that by the end of the video the whole topic will become much clearer to you. Hi guys, and welcome back to my channel. My name is Anastasia, and on this channel we talk about investing, and especially investing for beginners. In today's video we will be covering the topic of CFDs. I thought this was such an important topic that every beginner investor should understand, and all the new platforms for beginner investors, they offer you this option to trade CFDs, and if you don't know what it is, the potential of you losing money is actually quite high. But once you understand what a CFD is, how to use it, and the potential risks that CFD trading involves, you can use it in your favor and actually make a lot of money and a lot of profit on it. In my opinion, there are three main groups of people who make money on CFDs. The first group consists of all sorts of psychics, astrologists, palm readers, and all other people who can see the future. Because when it comes to CFDs, it's very important to know where the price of the stock will go, whether it will go up or down. This is the only way how you can make money on CFDs. The second group are the brokers. For them, it's a great opportunity to make money on you as well, because they sell you something that doesn't actually exist. There is no underlying stock with CFDs, so you don't buy anything, you're just betting, you're just making a deal with the broker on whether the price of the actual stock will go up or down. The broker will make money on you in case you were wrong, but the actual broker doesn't sell you anything. On top of that, brokers charge you fees on CFDs, which sounds like a great deal for brokers. The third group are the day traders, very experienced and professional people who spend a lot of years trading and who spend a lot of hours every day researching the topics, looking at graphs and analyzing them. And even those traders will never be able to give you a 100% guarantee of where the price of the stock will go, but they can have a very well educated guess on how the price of the shares will change in the future. There is also a fourth group of people who makes money on CFDs, but not as consistently as the first three groups, and the fourth group consists of lucky people, those people who were lucky once or twice and actually made some profits on CFDs without understanding how this thing actually works, but nobody can be lucky all the time. That's why in the long run, this fourth group of people will probably actually lose money rather than make any profit. For those of you who still think that CFDs is something that's interesting for them and something that they'd like to start trading, let's look at what a CFD actually is. So the letters CFD stand for contract for difference. The main difference between a CFD and the normal stocks and normal shares is the fact that when you buy a CFD, you are not buying anything. There is no actual stock that you're buying. It's a very similar idea to betting. When you bet on some sports website, when you think that your football team will win, you put some money on it, but it doesn't mean that you're buying a part of this team. You are not buying any players. It's the same with CFDs. When you think that a certain stock will go up or down, you can buy a CFD and you can win, or in other words, you can get some profit if your bet was correct. And it wouldn't be such a big problem if people were betting or buying CFDs with just the money that they have. But the biggest risk that is involved when you are talking about CFDs is the fact that you can use leverage. A leverage is basically the same as the mortgage. It's the amount of money that you can borrow from your broker to be able to make this bet. What that means is, for example, if you are buying a Bitcoin today and you are sure, although how can you be sure? But let's assume for educational purposes that you are sure that the price of Bitcoin will go up. You are so sure in it that you would like to increase the profit that you will get after the price of the Bitcoin will actually go up in real life. But you don't have enough funds right now. And by investing £100 of your own money into Bitcoin, you actually get £500 worth of Bitcoin back into your account. In this case, your position will be £5 times leveraged. You got 5 times more than what you invested. There are two main problems with it. First one is that nobody will give you money for free. The brokers are not an exemption, and when they give you this money, when they lend you this money, like with any bank, the broker works the same way. They charge you some fees, so you will have to pay to the broker for borrowing this money. On top of that, the second risk is what will happen if the price of Bitcoin doesn't go up but goes down. Under normal circumstances, if you didn't use leverage, the maximum amount that you could lose is just the money that you invested. This is the money that you actually had, and you always have to invest the money that you are prepared to lose. In case with leverage and CFD positions, you can lose now not just £100 that you initially invested, but all £500, meaning that you still have to pay the money back, and this is the money that you never owned and never had. Then you have to think about the ways of getting this money to get out of your debt, and these stories not always have happy ends. The most famous story happened recently in America with one of the users who registered on Robinhood, an American app for beginner investors. The next huge difference between a CFD and a real stock is the fact that you can actually make money with CFDs if the price of the stock goes down. What happens with the real stock? You buy a share of any company for a certain price, and you make a profit only when the price of this share goes up, and of course if you decide to sell it on. If the price of the share goes down, there is no way for you to make money, because that means that you invested more than you can get potentially when you sell your share. The situation is different when it comes to CFDs. Because with CFDs, as I said at the beginning, you don't buy the underlying stock, you are just betting on the price change. And if originally you bet that the price of this share will go down, if it actually goes down after you put your bet, you will make the profit anyway. Another thing that you should consider if you decide to trade with CFDs is the fact that usually CFDs include a lot more fees than underlying stocks. If we take Etoro as an example, if you use leverage, you always pay more, you take on higher risks, but you of course can get higher profits as well. Brokers, if they are FCA regulated, are obliged to tell you about the risks involved when it comes to CFD trading. And this is what the majority of brokers do anyway. But surprisingly, it doesn't stop people from getting into this trap of constant trading and constantly trying to guess the market, even though absolutely everybody knows that it's impossible to guess the market. I personally don't trade CFDs because I don't feel confident enough, and I don't think that I know the markets that well to make such strong predictions. But I also understand why people do it. So to stop this video from sounding all gloomy and doomy, let's look into positive sides of CFDs. Another difference between a CFD and the real stock is the time that investors usually hold their stock for. A lot of investors buy real stock to hold long term, and they sell it on only in several years. With CFDs, the situation is different, and this is something that usually the investors use for day trading. It's much easier to execute your orders for the broker because they don't actually have to buy the asset and register it under your name. CFD is just a simple way of doing it. Another example of investors who use CFDs are Forex traders. People who trade Forex usually trade currencies against another currency. They usually come in pairs. And if it wasn't for CFD, it would mean that the person, the trader, would have to actually buy a certain currency and then exchange this money for the other currency. But CFDs make this whole situation much more practical and convenient for the investor, because the investor doesn't actually have to buy any money. Other two terms that are very closely connected to CFDs are long and short positions. When you say that someone is long on the stock, that means that the person thinks that the stock will go up. For example, you go and buy a share of Apple for $120, and you think that the price of this share will grow. That means that you are long on the stock. You are opening a long position, but on your profile in Etoro, you'll have to click the button buy, even though you don't actually buy anything. You are just opening a long position. Another situation is when you buy an Apple share for $120, but you think that the price of an Apple share will go down in the nearest future. So you don't actually want to buy anything, but if you imagine that you had a real share in your hands, you would like to sell it now because you think you are sure that the price in the nearest future will go down. So why would you want to lose money? So this is when you sell your share that has never existed and you never actually owned. But this is the terminology that is used in CFD, which some people might find very confusing. So when you sell the share that you never had, that means that you are short on the stock and you are opening a short position. Then in the future, if the price of this share does actually go down, you will make the profit depending on the difference when you decide to close your position. By the official statistics, 67% of people lose money when it comes to CFD trading. And now I would like to show you how you open a CFD position on Etoro and how easy it is to open a position there, and then how easy it is to lose money once it's done. I am now in my virtual account. I don't want to buy and open any CFD positions with my real money, that's why I'm using my virtual account. So like with any other position, you have to go to your search bar, and for example, because I gave the example of Apple, let's look at Apple here, and you click trade as always. And with just a normal position, it shows here that you are buying the underlying asset. You see this when the leverage is 1. But as soon as you change the leverage and you put it to ×2, straight away it changes to a CFD trade. High leverage means high risk. You also see the overnight fee, you see below the button set an order. Another thing that I would like to show you, like if we change it back to no leverage position, it changes back to you are buying the underlying asset. But also look at these two buttons at the top of the screen. At the moment we are buying the stock. But if we change it to sell and we click on sell, straight away, even though the leverage stays 1 × 1, so there is no leverage, it still says that this is a CFD trade, because obviously if you don't own any Apple shares, you cannot sell any when it comes to real stock because you have nothing to sell. But when it comes to CFDs, it's not a problem. You can sell something that you don't own, just as you can buy something without actually buying anything. I find it very confusing how they use exactly the same terms of selling and buying when you don't actually sell anything and you don't buy anything. I don't think they're actually trying to confuse you, but the general idea is very confusing itself. And with this terminology that is used for both underlying assets and CFD trades, it becomes even more confusing. So what you have to do next is obviously set an order or just buy. At the moment we cannot buy it because it's Sunday and the markets are closed, but the rest of the trade is exactly the same. You still have to put the number of units or the amount of money that you want to invest into it. You just have to decide whether you want to make a bet that the price of the Apple share will go down or that it will go up. I think that it will go up, that's why I have to click buy, and I'm going to use a ×2 leverage position. And just for an example, I'm going to put here $100. It doesn't really matter. And then I have to set an order. Look, because I put $100, the overnight fee changed straight away and the weekend fee changed as well. The weekend fee is 3 times higher than the overnight fee. So then you click set order and it's done. And it's just that easy. That's it, guys. Thank you very much for watching. I hope you understood the basic idea of CFDs. You understood the risks that are involved if you decide to trade CFDs. You also understood the advantages and the reasons of why CFDs were created on the first place. And then it's just up to you whether you want to go with it or not. Don't forget to subscribe to my channel and to like this video if you found it useful or interesting. If you have any interesting ideas that you'd like to share with me, please share them in the comment section below. Thank you very much and bye bye.